40% increase over 5 years. Fabulous. With a 40% increase, despite top line, if they can increase their operating profit by 40%, that's great, and there's a lot of room there to increase dividends, and that's probably why they've been able to increase the dividends over time. Hey everyone, this is Ian from ppcian.com. I am back with another video about dividend growth investing. So today's video is really exciting. It's the second video in my series on how I personally analyze dividend growth stocks. So today's video builds on the last video. If you haven't seen the last video yet, I will link to it in the description below. That first video goes through my basic screens that I use, the filters that I use to determine if a dividend growth stock belongs on my personal watch list. Now that a stock is on my watch list, what I like to start with is the income statement. So today's analysis, today's video is all about how I approach income statements, especially from the mindset of a dividend growth investor, someone who is investing for passive income and cash flow, and someone who is going to hold on to the stocks that I buy for multiple decades, if not forever, in perpetuity, because I buy stocks for passive income and cash flow through dividends. So the stock that I am analyzing for this particular series of videos is Kimberly Clark. So Kimberly Clark, if you haven't heard of them, they are a large global company based out of the United States, and they purchase household goods, specifically in the paper industry. So they're probably best known for their Kleenex brand of tissues and for their Huggies brand of diapers. So I want to jump right into the income statement. So first and foremost, what is an income statement, and where do you find an income statement? Well, an income statement is a statement that a company typically publishes every quarter and also includes in their annual report as well, and it shows how much income is coming through the door, literally. What are the sales, what are the cost of selling those goods, and how much income, how much money is the company earning? And this is one of the most fundamental things to analyze in the world of personal finance when evaluating dividend growth stocks, because after all, when we invest in stocks, sometimes we forget this, but we're actually investing in businesses. We are becoming part owners in businesses. And why does a business exist? Of course, there's probably a greater purpose and they want to do a lot of good in society. And those are the types of businesses oftentimes that I like to invest in. And I believe Kimberly Clark does a lot of good in society, especially for all of the kids out there that need diapers, really good diapers. But even more than that, companies are in business to help consumers and to turn a profit and to drive income, to drive sales. And so if a company cannot manage their sales, they cannot manage their cost of goods sold, they cannot manage their net income, one is going to find that right away on the income statement. So I'm going to jump right into it. As always, I took some notes, a lot of notes for this video. So first and foremost, where does one find the income statement? Well, for Kimberly Clark and for most companies, I like to go directly to the source. And so what most big companies have is an investor relations section on their website. I went to the investor relations section on Kimberly Clark and I pulled out a few of their quarterly reports and a few of their annual reports. The quarterly reports are called 10-Q or 10-Qs. The annual reports are called 10-K or 10-Ks. And so you have to scroll sometimes through a lot of filings because there's a lot of filings with the SEC, oftentimes at large public companies. Whenever a director or a high-ranking official sells stock, it gets filed with the SEC. It has to show up in these reportings. So sometimes you have to scroll through hundreds, literally hundreds of these reportings to find what you're looking for. But what I'm always looking for is the 10-Qs and the 10-Ks. And I like to go through a bunch of them, and I like to jump first right into the income statement. So what is the first thing that one looks at on the income statement? Well, what I like to do is just get a quick snapshot of what's going on right now. Right now, what is happening with Kimberly Clark? And one of the easiest ways to do that is to look at the most recent 10-Q. So I pulled their most recent 10-Q, And I started looking at metrics in the 10Q. And the first one is called top line or revenue, or oftentimes called sales. I think Kimberly Clark called it sales. All of these words are synonymous with each other. Sales, revenue, top line growth, all that kind of stuff. And so I looked at the top line, and for the 3 months, I looked at 2 periods in the latest 10Q. They made it really, really easy for me. I looked at the 3 months ended September 30th, and I looked at the 9 months ended September 30th. And I looked how they did in those periods, but also how they did in the same periods a year ago. Because oftentimes what's most important, for me at least, is year-over-year comparisons. I don't like quarter-over-quarter, by the way, because most companies out there have some level of seasonality in their sales cycle. Even companies that aren't cyclical, like Kimberly Clark, there's probably certain periods of the year where they have just a sales cycle. And so it's always important to look year over year and not quarter over quarter. And so anyways, we started looking. And in the 3 months ended September 30th, their sales this 3-month period were $4.64 billion. And a year ago, they were $4.594 billion. So sales are up 1%. Right off the bat, that is a flag. That is a level of concern in that it's not bad. I'm happy that they're showing some top line growth, but typically 1% is less than what I would like to see. I would like to see something for a well-established, huge blue chip company, somewhere probably in the 3 to maybe 5% range, maybe even as high as 6 or 7%. You get much higher than 7% for a company of this scale, it might be hard to sustain, but certainly at 1%, it's not bad, but it's not great. So that's something that I checked off right away. That's a flag, an area of concern. And it helps tell the story. I was wondering, why is Kimberly Clark down so much? Why is this stock that I've been holding for many years? I've been buying since back, I think I started around 2011 or so. Why is it not doing so well? Why is there this quote-unquote buying opportunity right now? Well, this right off the bat gave me some level of indication. Okay, sales growth's not quite there, and it's something I'm going to have to dig into a little bit more. And in the 9 months, it tells the same story. The sales were up 0.14%, so even less when you do the 9-month comparable periods year over year. So sales, easy. It's just what's being brought in. Next, what I like to look at is gross profit. So gross profit is basically the profit that the company is earning after cost of goods sold. So it's really revenue or sales minus cost of goods sold. That's your gross profit. What is cost of goods sold? That is basically how much money it takes the company to literally produce the goods that they're selling, to manufacture these goods. And so we'll get into this later, but it does not include marketing. This is really important for a company like Kimberly Clark. It is a global brand company that relies heavily on marketing. Marketing is not included in that cost of goods sold. It's literally the cost of producing the goods. So anyways, gross profit is down. When I look at the 3-month period, gross profit is down 0.66% year over year. When I look at the 9-month period, it's down 0.36% year over year. And so, okay, again, Ian, a little bit of a red flag here. Why are you facing a buying opportunity right now in Kimberly Clark? Well, maybe the stock is down as a reflection of some of these numbers. Gross profit is it's not horrible. It's just slightly down. It's trending, down less than 1%. I would say it's basically flat, slightly down. So next, what I look at is gross margin. Gross margin is literally gross profit divided by revenue. So it's what is the margin percentage that they're earning after cost of goods sold on their gross profit. By the way, for most dividend growth stocks that I buy, it really varies by industry. But in general, for a world-class blue chip company with a brand name company, I'm looking at gross profit margins between, I would say, high 20s, maybe like 28%, and anywhere as high as 50%. That's the range. If a company is driving gross profit, say like at 21% or like 15%, the cost of producing those goods is so high as a percentage of what the company is receiving for selling them, that it leaves little margin for error, little room for error. So a company like Kimberly Clark, where the gross margin percentage, it's right now 35.75% in the last 3 months, ended September 30th, that's a great number. Just in broad terms, 35% is the gross margin that I like. So there's a lot of room there, a lot of room should stuff happen, should the cost of selling these goods, cost of producing these goods go up. So just a rule of thumb that I like to look at, somewhere between high 20s and low 50s. Okay, so gross margin, well, gross profit we talked about, it's flat to slightly down. Gross margin is also down. So it is at 35.75% versus 36.35% 1 year ago. And that's a 3-month comparison. For the 9-month comparison, we're at 36.23 versus 36.41, so slightly down. Look, it's basically flat, slightly down. This isn't a deal breaker for me, and this is something that I think is really important when we talk about the last video. If something goes wrong in those I think it was 7 different screens that I do to get something from idea in my mind to watch list, if one of those is way off, look, I probably discount and disqualify the stock right then. The important nuance with this video and in most of the videos I'll have going forward on this topic is this type of financial analysis is an art form. And when you are marrying a company like I do for decades on end, if not forever, there are cycles. And not all of the numbers are always going to line up. And so these are red flags in the sense that, Ian, you need to investigate these things. This is why your stock is down. This is why there is your quote-unquote buying opportunity. But these are not deal breakers. These are definitely not deal breakers. They just set the stage for what I need to look into as I get further down my analysis. So it's a really, really important distinction that I want to point out. So let's look next at operating margin and operating profit. Operating profit is really important because, like I said, gross profit does not include the cost of marketing. Operating profit does. And with a big global company like Kimberly Clark, marketing is half the challenge. It's probably not the most difficult thing in the world to produce a box of Kleenex. What is the magic of Kleenex? It is the distribution network of Kimberly Clark, it's the history, it's the brand name, and it is the marketing. And so oftentimes for companies like this, I don't really care as much about gross profit as I do about operating profit. And so operating profits are up. In the 3-month period, they're up 2.15% year over year. 9-month period, they're up 0.36% year over year. So that's interesting. Even though revenues are flat, slightly down, gross profits flat, slightly down, operating profits are up. So they found some efficiencies internally. They found some efficiencies to cut costs to become more streamlined. Now, this could be looked at as a good or bad thing. Time will tell. Basically, if they cut too much on marketing, that could hurt future sales. It could be a downward trend. However, if they made smart optimizations, maybe they used world-class technologies to become more efficient at marketing and to market their marketing dollars more efficiently, it's a win-win. And I tend to look at it probably as the second case just because I'm very familiar with digital marketing, and the amount of technology that's out there now is amazing. And most marketers, half the money they're spending is just completely wasted. And so what these technologies do is they allow the marketers to find the half of the money they're spending that is completely wasted and to cut back on that without influencing or hurting sales. And so I tend to look at this operating margin trend as a good thing. Or operating profit being up is a good thing, and quite frankly, operating margin. So we just talked about operating profit. If I look at the margin, which is literally operating profit divided by revenue, that's also up. So last 3 months, 18.41% versus 18.20 a year ago. 9 months, 18.18% versus 18.14 a year ago. So it's looking all right. Okay, let's move on. Net margin. Or net income, sorry. Net income takes into account not only the cost of goods sold, such as gross profit does, not only the marketing expenses, such as the operating income does, and it furthermore takes in interest and taxes. And so with interest, taxes, the bottom line, revenue is also oftentimes called top line. Bottom line is net income. The net income is up 3.0% in the last 3 months compared to a year ago, and it's flat basically, 0% in the 9-month comparable period. Not great, not bad. There's a story that will unfold here, and this is quite frankly why I start with this micro level snapshot of the last quarter, because it tells me what's going on right now with this stock when I'm trying to buy it right now. And I don't want to get too caught up, quite frankly, on the latest 10Q, because I'm married to these companies for decades on end, if not forever. And so the last 3 months, it's probably irrelevant in the bigger picture, but I like to start there because it tells me the story, what's happening now. As a general rule of thumb, if net income is only up 3% year over year, that may not be enough to sustain the larger dividend increases that I like to see as a dividend growth investor. I like to see increases over time anywhere between 5 and 7% each year. Net income should be going up a similar amount to afford those dividend increases. Otherwise, the payout ratio is going to increase, meaning the amount of dividend income that goes out as compared to net income, the ratio is going to go higher. And I like my payout ratios to be anywhere between, I'd say, 40 and 60% range, sometimes as high as 70, but really depends on industry. But for a company like this, payout ratio in the 60s, high 60s, probably fine. I don't want it to get too much higher than that. And so net income has to grow to support dividend increases. Or another way of looking at it is the rate of dividend increases won't be as high in the future if net income doesn't increase. And so something is important to look at. Net margins for Kimberly Clark right now are 3-month period are trending up, 12.2% versus 12.0 a year ago. 9-month period, they're slightly down, 12.1 versus 12.2 a year ago. It's basically flat. So this tells me a lot of what I need to know right now just for what's happening now. But this is just the beginning. So the next thing I do when I'm analyzing income statements is I look at the 10K, the annual report. And I start looking what's happening on a year-by-year basis for the last 5 or 10 years. I start with the last 5 years. This really, for a dividend investor, in my opinion, is a lot more important than the last year over year, 3-month periods, because, again, I'm in this for a very long time. So anyways, their fiscal year ends December 31st, and I looked at it for 2012 through 2016. And when I look at revenue, boy, this is an interesting story. It's down 6%. So again, not a deal breaker, but this is a red flag. This is Ian. This revenue story here continues. And by the way, when I bought back in 2011, this hadn't manifested yet. So Ian, since you originally bought, do you have the conviction to add to this same stock? Do you have the conviction, the same conviction you had when you bought this stock as a dividend growth investor to get from where you are now to where you need to be? You have a long way to go. You have over 30 stocks to choose from. Should you really be adding to this one? Something is manifesting differently than when you looked at it before. And these are the type of stories, and it's kind of like you have to be like a sleuth. You have to really look at these clues and kind of decipher everything to determine what's the best solution, best course of action for one's personal portfolio. But anyways, I look at revenue, 2012, 2016, it was at $19.467 billion. 2012, 2016 was at $18.202 billion, so down 6%. Interesting. Okay, gross profit though is up 8.5%. So they become more efficient. With the globalization, increases in technology, ability to outsource overseas to different countries, production processes, despite revenue going down, this company has managed to squeeze out an 8.5% increase over the last 5 years in gross profit. It's gone from $6.1 billion up to $6.651 billion. That's good. Is it good enough? Probably not. I'd like to see that more like maybe 15% or more. I feel like 8.5% over 5 years gross profit increase, that's not enough to sustain huge dividend increases in the future without increasing the payout ratio, and at a certain point the payout ratio can only be so high, and then dividend increases will be slower, if not flat. So something to be mindful of, and I flag these things. Gross profit, I like this though, it's gone up. Obviously it makes sense with revenue down, gross profit up. The gross profit percentage or gross margin is up, and it went from 31.4% to 36.5%. That's cool. I like to see companies increase their gross profit over time. It shows a responsible company. Next, operating profit. Wow, did I write that correctly? I guess I did. So this is probably one of the things that attracted me to this stock so much when I first started is the efficiencies. And this goes back to what I was talking about with marketing. They've gotten a lot better at their marketing, and I respect that because I have a marketing background. And their operating profit's gone from $2.377 billion to $3.317 billion, or a 40% increase over 5 years. Fabulous. With a 40% increase, despite top line, if they can increase their operating profit by 40%, that's great, and there's a lot of room there to increase dividends, and that's probably why they've been able to increase the dividends over time. That being said, when we look at 2017 versus 16, the operating profit it's slightly up, 2.15% in the last 3 months, or 0.36% last 9 months, but it's slowing, seems to be slowing. And so I'm sure there's more there. I'm very aware of the advances that are happening in digital marketing right now, and I think it will only get better. There's still a lot of marketing spend that is just wasted, and they'll be able to cut that waste to increase margins. So that's good. But at the same time, just something I want to point out with operating profit. Companies can grow that operating profit only so much. At a certain point, the top line has to grow. And so I don't want to lie to myself here. I don't want to skew the numbers in my mind to make a case to buy a company that I love because I have an affiliation with their brand. I want to be very objective here. And I have to continue to be very objective that, yeah, this is great that this operating profit is up. It's probably one of the things that really attracted me to this business, other than the brand name. But look, Ian, at some point sales have to go up again. We'll get more into that later. Operating profit percentage or operating profit margin has gone up. 2012, it was 12.2%. 2016, 18.2%. That is nothing other than a miracle, in my opinion. That is fabulous. And honestly, I'm surprised I bought back. Well, not surprised. I mean, it's a world-class company, but that's at the lower end. Buying a company with an operating profit of 12.2%, that's a little bit lower than I tend to go. So the fact now that it's up at 18 is good. I feel good about that. If I were buying now and it was only 12, I might question it a little bit more, or probably a lot more. Okay, net income. Over the 5-year period, it's up 24%. So why is it not up as much as operating profit? It seems like there's something happened on the interest and tax side. I'll have to look into that later. That will manifest a little bit later in my analysis. But for now, I'll just take it at face value. 24% over 5 years, net income increase, that's fine. I'm okay with that. That's enough to sustain my growing dividend. It's not too fast, not too slow. It's good. So they went from 1.75 billion to 2.166 billion. A lot of net income there. So the net margin's gone from 9% in 2012 to 11.9% in 2016. So there's a lot to love here on the numbers as we get further down the income statement. There's a lot to love on the operating profit, operating margin. There's a lot to love on the net income, on the net profit margin. There's not as much to love on the top line, on the revenue, and on the gross profit, gross margin. Even though the gross profit, gross margin is up 8.5%, it's not enough, in my opinion. The top line, the revenue and the gross profit, I'd like to see them up even more. So let's go on. Now, earnings per share. We're up 36%. From $4.4 per share to $5.99 per share. Earnings per share is important to look at, mainly because I tend to not like companies that only grow their earnings per share through stock buybacks. So there's this concept of the stock buyback. It's become very popular in recent years. A lot of companies do this as interest rates are low. So they take out debt. We'll see this on the balance sheet analysis, which will be my next video. But they take out debt. They use the debt to buy their own stock. In my opinion, this is okay to an extent, but at a very large scale, I look at it as a little bit of financial engineering. I don't like it. I like it okay because I certainly don't like companies that issue a lot of stock and dilute the value of my stock by issuing too much stock. So I like companies that keep the amount of shares outstanding flat or slightly declining. It's fine to buy some back. I like it when they buy it back through profit. In addition to paying a dividend, if they take some of their net income and they buy it back, that's great. But companies that actually take on debt, on loans to buy back shares, that's where I start getting a little bit more concerned. It's okay to an extent, but I am mindful if it's too much. So anyways, net income per share, it's up 36%. It's up faster than net income. Why is that? I imagine the amount of shares outstanding has decreased. I didn't actually look at that, but I'm inferring that from the numbers. So I've got some stuff I got to look into here. The main thing I need to look into here is what the heck is going on at the top line at Kimberly Clark. It's presented a buying opportunity. What's going on? So first thing I did is I just started looking through the 10K a little bit more. I started looking at sales. North America, sales are trending up. Generally, everything else is trending down. Wait a minute. This makes sense. There's been a global recession that we're now recovering from. North America is probably leading the global economy in the recovery. The other countries are starting to catch up, but we're just starting. And so this Great Recession was a very big deal. It was a very big impact on the global economy. And so one of the things I think is happening is Kimberly Clark, being a global company, is making a balancing act in the recovery. They're cutting, I shouldn't say cutting, but they are. They're cutting costs by becoming more efficient, more effective, to bolster their gross margins, their operating margins, their net margins. So they've done a great job at that, but they're still facing the tail end of this global recovery. It hasn't come to fruition yet that the global growth, a resurgence in global growth is helping them. And so that tells me at a macro level, I believe that US, we're kind of getting maybe towards the later stages of this recovery, and there will be a correction at some point. I don't know when. Globally speaking, I think we're still in the middle of this recovery. I think there's some ways to go. And globally, I also see a very bright picture in the future for emerging markets. And emerging markets, we're starting to see consumers who have disposable income, and they're going to want the premium brands like many people in the United States have the luxury of enjoying, such as Kleenex and Huggies. And so I tend to look at this as a phase in the life cycle. And like I said, I marry these companies for decades, if not forever. And so this helps me. When I look at things by region, this helps me understand what's going on. Next, I want to do a little more digging. Last 5 years isn't enough. So I went back to the 10K from 2012. And I wanted to look what happened between 2008 and 2012. Okay, I went even further back. Then I looked at the 10K from 2008. What happened between 2004 and 2008, specifically with top line revenue growth? Well, between 2008 and 2012, top line grew 8.5%. Probably, I imagine a lot of that was front-loaded between 2008 and 2009, right before the recession was hitting, or just starting to hit. I imagine in 2010, 11, and 12 is probably more sluggish. I'm just guessing here. 2004 through 2008, wow, top line was up 29%. Huge top line growth for a company of this size. So this tells me, okay, Ian, when you bought back in 2011 circa timeframe, this top line growth totally aligns with the type of decision I would have made at that time. Makes sense. It's slowed, but it's still good. Since then, I think the recovery took longer than many people imagined. Globally, it's still happening. United States, it's still happening, but United States were probably more towards full recovery. This paints the picture for me. So obviously at this point, I can't make a decision whether I'm going to buy more shares of Kimberly Clark. This is just the first stage of my analysis after getting it from idea to watch list. I did that. That's just kind of the basic screens that I did in the last video. But certainly now I have a great picture of what's happened. I know what's happened now in the last few years. I understand why the stock has corrected. I think there's probably some concern on the top line. And if that top line is going to come through, I think the company has done a great job with the operating margin, with the net margin. Despite challenging economic times, especially globally, in the last 5 years, they've managed to bolster their numbers through smart operations. I like that. It's important for a company of this size to be scrappy. I think the sales are going to be a challenge for the company. I think they will come around. I think we're just at the point now where they're going to start coming around. That's kind of what I'm thinking at this point is, yeah, it's a red flag. Is it a deal breaker? No. There's always going to be a red flag, or if not multiple, when a stock I love is on sale, which I believe Kimberly Clark is right now with the reasonably attractive PE ratio, given this market we're in, and the very attractive dividend yield, given this market we're in. I think the dividend is safe, given the numbers I've looked at so far. I think that it's on sale for a reason. Am I able to go in eyes wide open and embrace the reason it's on sale and buy more? I'm starting to get there. Obviously, I'm going to do many more videos here in this series of how I analyze stocks. This is just the first one on the income statement, but that's where I'm at right now. So just in terms of full disclosure, I am a shareholder in Kimberly Clark, ticker symbol KMB. I am long on that stock, have been for a while, will continue to be, keep buying in. I've been buying in regularly lately. I've been averaging in. And so also, just as a disclaimer, this is not financial advice. I am not a licensed financial advisor. Today's video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. So before I leave today, I want to sincerely thank all of you. I passed 1,000 subscribers. I'm really proud of that. I am now actively building a studio. It's not going to be really fancy, but what it will do, as I had promised to everyone out there, is it will allow me to probably a better production quality on the videos, but two, allow me to film even at nighttime. Right now, I'm really tied to these daytime hours. I'm really tied to the weather being good. It's a little more difficult, so I'll be able to film at nighttime and produce more videos about dividend growth investing. So I thank everyone who's supported this channel. The comments, the likes, the subscriptions, they mean the world to me. The fact that I made it past 1,000 subscribers, that was a big goal of mine. It was really a goal for me to know, hey, Ian, do you want to take this to the next level? Do you want to make some investments? And I feel comfortable doing that now. And so I'm really excited about that. And I truly thank all of you. It means the world to me. And this channel wouldn't be where it is without the subscribers and without the questions and the community. That's my favorite part of it, because it not only is it fun for all of you, but it keeps my skills sharp. I love these questions. I love thinking about them, researching them, answering them. Makes me a better investor as well. So I will see all of you in the next video. Thank you so much for watching.